What's going on, everyone? It's AdWiz, and you're watching the channel where we make personal finance not suck. Frankly, I think selling a stock well is probably a harder discipline than buying it cheaply. Even Warren Buffett says that selling a great business because of bad news is usually a bad decision. Today we'll discuss when and how to sell stocks. We're going to be covering 4 major points that I personally look at myself, so make sure to stick around until the end of the video. The first thing you need to do when deciding if it's time to sell a stock is to look ahead. Many people make the mistake of looking at the past instead of the future when buying and selling. Just because a stock has gone up in the past doesn't mean it will continue to go up in the future. And just because a stock has gone down in the past doesn't mean it will continue to go down in the future. When investing, it's important to be forward-thinking and try to anticipate what's going to happen in the future. For example, let's say you're thinking about buying Apple stock. You might look at Apple's past performance and see that the stock has done very well over the last 10 years, but that doesn't mean that Apple stock will continue to do well over the next 10 years. Look ahead and try to anticipate what's going to happen in the future. The next major reason why I might consider selling a stock is if it's extremely overvalued. This is a critical aspect of investing that can often be overlooked by those who are new to the stock market. By this, I mean I look at the company and their fundamentals, such as their revenue, profit margins, and growth potential, and I simply can't justify the price it's trading at. When the stock price is far higher than what the company's financial health and future prospects can support, it raises a red flag. A great example of this was the dot-com bubble of the late 1990s. This period was marked by a frenzy of investment in internet-based companies. During this time, investors were pouring money into internet companies, regardless of whether or not they had a viable business model. The excitement around the potential of the internet led to irrational investment decisions. As a result, the valuations of many internet companies soared to unsustainable levels. Stocks were being bought at prices that had no relation to the company's actual earnings or potential for future profits. Many of these companies were trading at hundreds of times their earnings, or even worse, they had no earnings at all. This kind of overvaluation is a clear sign of a bubble. When the dot-com bubble eventually burst in 2000, the valuations of many internet companies plummeted. The market correction was swift and brutal. Some companies saw their stock prices fall by as much as 80 or 90%. It was a bloodbath. Investors who had bought at the peak faced devastating losses. And it wasn't just the small, unprofitable internet companies that got hit. The ripple effects were felt across the entire market. Even large, well-established companies like Microsoft and Cisco saw their stock prices fall sharply. These companies had solid business models, but their stock prices had been driven to unsustainable levels by the market mania. It took years for these companies to recover from the dot-com bubble. The recovery process was slow and painful for many investors. And this is a perfect example of why you need to be careful about buying stocks that are extremely overvalued. Overvaluation can lead to significant financial losses when the market corrects. Even if the company is a great company, if the stock price is too high, you could be setting yourself up for a big loss. It's important to always consider the intrinsic value of a stock. So how can you tell if a stock is overvalued? There are several key financial metrics that can help you make this determination. Look at the company's price-to-earnings ratio, price-to-sales ratio, and debt-to-equity ratio. These ratios can provide insight into whether a stock is trading at a reasonable price relative to its earnings, sales, and debt levels. By carefully analyzing these metrics, you can make more informed investment decisions and avoid the pitfalls of overvaluation. Chapter 3. Portfolio Balance. The next reason why I might consider selling a stock is simply to maintain my portfolio allocation. This is a crucial aspect of managing your investments effectively. For example, say you invested $10,000 into Apple in 2010, and because of their incredible growth, it's now worth $100,000. This kind of growth can significantly alter the balance of your portfolio. Well, depending on how the rest of your portfolio did, Apple might now make up 60% of your portfolio. This can create an imbalance that might expose you to higher risk. Now, if you're extremely bullish on Apple and think they're going to continue to crush it, that might be okay. However, it's important to consider the potential downsides. But if you want to manage your risk a bit better, You might decide to sell some of your Apple stock and use that money to buy other stocks or assets. This strategy helps in spreading out your risk. That way, even if Apple were to underperform, the rest of your portfolio wouldn't be as affected. Diversification acts as a safety net for your investments. The key here is diversification. By spreading your investments across different assets, you can protect yourself from market volatility. You don't want to put all your eggs in one basket. This old adage holds true in the world of investing. By diversifying your portfolio, you can reduce your risk and increase your chances of success. A well-diversified portfolio can weather market storms better. Diversify by asset class, sector, geography, and market capitalization. This means investing in different types of assets, industries, regions, and sizes of companies. The best way to diversify your portfolio will depend on your individual circumstances, such as your risk tolerance, your time horizon, and your financial goals. Each investor's situation is unique. It's important to speak with a financial advisor to create a portfolio that meets your specific needs. A professional can provide tailored advice based on your personal financial situation. Diversification is key to managing risk and achieving long-term success. By carefully balancing your portfolio, you can aim for steady growth while minimizing potential losses. Chapter 4. Better Opportunities. The final reason why I might consider selling a stock is if I find a better opportunity to invest in. This is a crucial aspect of smart investing. Like I said at the beginning of this video, buying or selling a stock isn't just about that one individual stock, it's about everything else in the market. The market is a vast ocean of opportunities, and each decision you make should be weighed against the potential of other investments. Because when you buy one stock, you're also choosing not to buy every other stock at that moment in time. This opportunity cost is something every investor must consider. For example, let's say you're thinking about buying Apple stock again, and you think it's a great opportunity. Apple has a strong brand, innovative products, and a loyal customer base. But at the same time, you also think Tesla is a good opportunity. Tesla is known for its cutting-edge technology and rapid growth in the electric vehicle market. Well, you need to decide which opportunity is better. This decision involves comparing the potential growth, risks, and overall market conditions of both companies. If you think that Tesla is a better opportunity than Apple, then you might want to sell your Apple stock and buy Tesla stock instead. This is a strategic move to maximize your returns. Even if you think that Apple is a good company. If you think that Tesla is a better company, then it makes sense to sell your Apple stock and buy Tesla stock. It's about making the best possible choice with the information you have. The point is that you should always be looking for the best possible investment opportunities. The market is dynamic, and new opportunities arise all the time. And if you find a better opportunity, don't be afraid to sell your current investments and move your money. Flexibility and adaptability are key traits of successful investors. Look for companies that are undervalued, growing faster than the market, or have a strong competitive advantage. These are the companies that can provide significant returns over time. Finding these types of companies takes a lot of research and due diligence. You need to analyze financial statements, understand the industry, and keep up with market trends. But if you're willing to put in the work, you can find great investment opportunities that can help you achieve your financial goals. The rewards of diligent research and strategic investing can be substantial, leading to long-term financial success. Outro: when to sell stocks, expert tips. So that's it for this video. Those are the 4 major things I look at when deciding if it's time to sell a stock. Overall, always look to the future, check the company's fundamentals, and don't be afraid to admit a mistake and rebalance your portfolio. Selling for a loss is never fun, but it's important to remember to not get emotional about your investments. It's always better to sell and free up your cash for a better opportunity than to hold on to a losing stock and hope for the best. Thanks for watching. Don't forget to like, comment, and subscribe for more financial tips and insights.